Welcome back. When it comes to spending money, people in the United States generally fall into one of three categories of spenders: the debtors, the savers, or what I like to call the wealth creators. Let's take a closer look at how each type manages their finances. First, the debtors. A significant portion of the United States population relies on debt to cover their primary financial obligations. Take a close look at the illustration. The horizontal black line represents $0. When the average person wants to buy a car, they typically go into debt to purchase it. Once the vehicle is paid off, they often take on new debt to purchase another vehicle. This cycle also applies to buying homes, paying for college tuition, and even funding vacations. Many rely on borrowing to sustain their lifestyle. While this approach can work, it's crucial for debtors to manage their debt responsibly. Next, we have the savers. Savers make up a much smaller portion of the American population. Let's take a closer look at the saver strategy. We still have the black $0 line, but savers approach financing differently. They set aside money in advance, and once they save enough, use those funds to purchase a vehicle, buy a home, or pay for college tuition. At first glance, savers might seem better off than debtors. However, savers often sacrifice something even more valuable: opportunities. Opportunity cost refers to the potential benefit one gives up when making a choice. When savers tap into their savings, their balance often drops close to zero. There's nothing inherently wrong with this approach. It ultimately depends on whether an individual is comfortable operating this way. In these two scenarios, a person can either use debt and pay interest to a bank or financial institution, or they can choose to save, earn interest, and use their savings for large purchases. In both cases, the debtor and the saver are ultimately working toward the same goal: reaching that dreaded black $0 line. Now let's take a look at the final category of spenders: the wealth creators. Wealth creators represent an even smaller segment of the American population. Their strategy begins with opening a properly structured whole life policy, similar to a savings account. Once the cash value reaches a certain level, it can be tapped for purchases. The key difference is that the funds come in the form of a loan from the mutual insurance company, a benefit of being an owner in the company. The wealth creators' cash value acts as collateral, allowing their money to continue compounding and growing even while they use the loan. This approach also provides the flexibility to customize the repayment plan. As the loan is repaid, the interest goes back into the account, further growing the policyholder's wealth. This simple yet powerful strategy enables the wealth creator to build wealth while funding their purchases. I think you'll agree that the wealth creator's approach offers many clear benefits over the other two. So which type of spender are you? In the next segment, we'll talk about compounding interest and amortizing interest. See you then.